Welcome back to On the Money with Ryan Wheelis, financial advisor, founder of Allied Wealth, offices all around the Houston area. If you're watching on the YouTube channel, we're always doing this introduction on here because we do a weekly radio show, KTRH, 1 p.m. on Sundays. But a lot of that, unfortunately, we get preempted a lot this time of year. We got football season, so a lot of different sports shows on. So thank you for coming over to the YouTube. But if you're listening on the radio, I want to do some of the tax takeaways, some of the things that are most important to think about before the end of the year.
Yeah, Spike, in this segment, what I really want to drive home is I'm going to give some folks, some real meat and potato stuff that they can use to reduce their tax bill legally. Nobody looks good in stripes, at least the vertical ones anyway. So, but the reality is that I think a lot of people don't realize that if you're going to do tax planning, it's got to be done before the end of the year. So we're coming up to the final days of the year to do some effective tax planning. So just an example here, Spike, tax loss harvesting. What is that?
Okay.
Well, if you've got positions in your portfolio that are down and you've got positions in your portfolio that are up, okay, here towards the end of the year, if you sell the losers and offset your gains in your winners, all right, so you sell your losers, sell your winners, harvest the gains, balance it out to where you can get to, in some cases, no effective capital gains rates, and then 30 days later into January, you buy those positions back. That's called tax loss harvesting, and it's amazing to me the number of people who overlook that. In fact, I have people that are higher net worth folks come in the office, and they're all proud. Hey, Ryan, I've been with so-and-so for, 5 years, and I gave them $1 million, and now I've got $2 million. And I'm like, okay, cool. Let's find out how good they are. And they're like, well, what do you mean? I'm like, well, let's look at what your tax basis is in this $1 million game. Is it, in fact, a $1 million gain, or were things done along the way to get some of that gain out of taxation or taxes harm, right? How are we harvesting gains along the way to reduce your overall tax liability? And it's mind-boggling to me, Spike, the number of people that are gracious for the amount of money they make on the way up. But what they don't realize is they harvest that gain in its entirety, they're going to pay a 23.8% net investment income tax. So if you've got a $1 million gain, all right, well, guess what? You don't have a $1 million gain. You've got a $770,000 gain because 23% of that gain is going to be eaten up by capital gains tax plus a 3.8% net investment income tax.
Okay. Yeah. I got to ask. I'm going to simplify it, and I'm going to say for the less informed, I'll call it the dummies, and I mean me. Okay? I mean me. I don't mean anything to anybody on the radio or the YouTube. When we say harvest, I get tax, I get loss, I get harvest. What is the actual verb of harvest? What do we do? Are we selling some of the gains and then attributing the loss?
Yeah, you sell your losers and your winners, okay? And you sell enough of your losers against enough of your winners to bring your capital gains tax rate on your winners to zero. And so that's a strategy called tax loss harvesting or tax gain harvesting, kind of the same thing, that allows you to harvest losses or gains. And the idea is to get gains out of your portfolio at a 0% terminal capital gains tax rate.
How many other firms out there then are talking? Do the big box firms talk about that?
No, they can't. And that's that too. You go to the banks, you go to the strip centers and some of the ones in the office buildings. They are precluded from giving tax advice. In fact, I've got a client right now that got tired of being ping-ponged from their advisor and their accountant back and forth. And I stepped in and said, listen, here's what you're trying to accomplish. Here's how we help you accomplish that. Why are we still having this conversation? And the guy moved all the accounts to us because we actually do provide strategies around taxation. Now, we fully back that up with, hey, we're not CPAs, but there are things we know how to do, like, for instance, a Roth IRA conversion that can really help mitigate long-term tax liabilities, right? And so there's things that your financial advisor can, in fact, help you with that many companies out there don't allow their advisors to give any tax information or strategies whatsoever.
Right. Now, this is not investing advice. I'm just going to use some names. Hopefully, maybe our radio and our video audience might. So let's say we've got NVIDIA, right? So there's a lot of gains just over the year, right? Mm-hmm. So then we're pairing it up against what? Let's go, I don't know, Bed Bath & Beyond. Didn't they declare bankruptcy? Let's do somebody who lost.
Here's an example, Spike. I've got a stock in my portfolio that was at $125 a share.
Okay.
I bought it at $30. It's at $125. It's pulled back to $100. Right, so it's down some. But if I wanted to get some of that gain, that $70 gain, I could sell some of that stock. All right. I've also got a few losers in my portfolio. I would also sell the losers. So the gains on my winners would be offset by the losses on my losers, because you can offset a capital loss against a capital gain and a capital gain against a capital loss. And what I would do is balance the amount I'm selling of each position to get the gain out of my portfolio at a 0% tax rate. Now, my stocks that are down that are losers, I still believe in. So I would buy them back in 30 days. And that avoids what's called a wash sell rule. So it's a strategy that folks need to know about. But listen, I know we're beating this one up, but there's more.
Right. Oh, no. Yeah. But I want to ask you, so this is essentially taking away having to pay capital gains? Because
it's not going to take it away completely, but it can certainly reduce the overall amount of capital gains taxes you pay. That should be done on an annual basis as you're building your war chest in your portfolio, especially in your non-qualified, non-IRA accounts. That's a big deal. And I see people get hosed time and time again because they think their advisor and the advisor's company did a good thing for them by this massive gain that they got. But if all your gain is taxable, no tax strategy was implemented on the way up to help you realize more of your gain. Because again, if I've got $1 million gain in my portfolio, I do not have $1 million gain. It doesn't work that way. You owe a 20% capital gains tax rate because you're above $550,000 and some change. All right. And you owe an additional 3.8% net investment income tax on top of that. So you sell $1 million, you pay called a 24% tax rate, 23.8%, but I'm rounding up. So 24% tax rate, you now have $760,000 in your portfolio. You just lost nearly $250,000 of taxes. You could have had your advisor on the way up as that money grew, doing some tax loss harvesting and getting some of that gain out of harm's way from taxes, so to speak, and had more of your gain in your pocket than not. And that's what tax loss harvesting can do for folks.
Okay. Now, and your financial advisor, you've got offices all around the area. You can help people figure this out. But as we come towards the end of the year and you get into the holiday season, this isn't something you can really start like that third week in December. We need to start acting on this as soon as possible before the year runs out.
Yeah, the year's coming out. December 31st, at midnight, any tax planning you can do for this year is over. It's over. Spike, here's another one. Section 179. I think the limit this year is $1.2 million. So if you've had a really good year in business, and a lot of us have, you can take $1.2 million deduction. Here's an example. If I were to go out and buy an airplane for $1.2 million and use it for business, I can take a $1.2 million off my income tax for buying that airplane. That's Section 179. But I have to do it, and that's not the exact number. It's close, by the way, the limit. I have to do it by the end of this year. I can't do it in January of next year, okay? Now, there's always these things. If you're buying something to offset taxes, you're still spending money. That's true, but there's things you can do. Another one, Spike, that I think is wildly overlooked is the HSA. If you're enrolled in a high deductible plan, maximize your HSA contributions. $8,300 for family plans in 2024 if you're 55 plus. Right. And those are just other things. If you got business income, you can defer income until the following tax year to reduce tax liability. And you can also accelerate deductions. But if you don't do that now, you can't do it. You can do charitable contributions. There's so much stuff that you can do. Yeah, look at your IRMA. What is the evaluated income timing for Medicare and IRMA, right? IRMA is the stealth tax. They don't tell you they're taxing you. They just tax you. All this stuff is so important, and I can't tell you, one of the biggest value adds we bring to the table at Allied Wealth is helping people navigate these landmines and pitfalls that other financial firms are precluded to talk about. And so you wind up getting ping-pong back and forth between your financial advisor and your CPA. CPA doesn't want to do it because they just don't. A financial advisor doesn't. It's not that they don't want to do it; they just can't because their firm won't let them. And that's a disservice. It's a great disservice to the folks of Houston. And we people plan for taxation.
For those of you,
the biggest expenses you're ever going to have in your golden years and while you're working.
For those of you listening on KTRH right now, we're going to go out to a very short commercial break. We're going to have news and weather here at the bottom of the hour, a little bit on sports as well. If you're watching on the YouTube channel, we're going to continue to talk about some of the things you need to think about before the end of this year. But dial the phone number right now. You can get your absolutely complimentary portfolio review, your portfolio x-ray, and that will include the tax conversation. What do you need to do before the end of the year? 844-944-7555. That's 844 944-7555. If you're listening in the car right now, dial that phone number. At least get it into your phone. You can call it later in the week if you want to. Or you can go to retirenowhouston.com. That's retirenowhouston.com. Schedule your own tax appointment right there. More with Ryan Wheelis, financial advisor, right after this.